Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have George Milling-Stanley. He's the chief gold strategist over at State Street Global Advisors. We're going to take a look at how gold has been performing throughout this bout of volatility, and it certainly has been quite a volatile market. And if you're catching this on the replay, of course, it's Wednesday, March 11th, and we're down historically low if you look at it year over year, but gold has been performing quite well.
Gold's done pretty well, yeah. I mean, it's gone down when there have been margin calls on equities. People buy equities on margin, get margin calls when the value of the equities goes down. They don't want to sell them at depressed prices, so they sell gold to meet the cash margin calls on their equities. We've seen this several times now. We saw it a couple of weeks ago. We saw it earlier today. But basically, I'm pretty confident that every time this happens, the investors come straight back into the market and buy the gold back because it's doing what it's supposed to do.
Why is gold a better hedge than some other longer duration treasuries?
I guess since the recovery from the great financial crisis started in early 2009, we always used to look at treasuries as being a hedge against potential weakness in equities, and that's been true for most of my life in financial markets. But in that 10, 12 years since that began, we've seen a much, much closer statistical relationship between the bond market and the stock market than anybody really likes to see, and bonds are not performing that hedge function that we used to rely on them for. Gold has proven to do that on many occasions in that 10, 12-year period, and I'm expecting that to continue going forward.
All right, let's talk about ETFs and GLD being the gold standard, if you will. How has ETF traded impacting the gold landscape?
As I say, it's dropped every time the equity market has dropped, but then the equity market has maybe dragged itself back to somewhere close to previous levels. Gold has gone on to go even better. The intriguing thing to me is that gold was already at $1,600 an ounce before the whole coronavirus thing came in, before we learned how to call it COVID-19 or whatever we're going to call it tomorrow, before we learned it was a pandemic. Gold had already made a terrific $300 move between last fall and this spring. And it's maintaining those gains is essentially what's happening.
Well, but ETFs in general, because that has increased the amount of trading that we see out there. Gold is an asset class. Has that complex changed at all because of the advent of ETFs?
I don't think so. I mean, I think that gold's position as a strategic asset and occasionally a tactical asset for safe haven purposes has been merely strengthened by the additional liquidity that the ETF world has brought to the gold world. We're an integral part of the gold market, but we're one of the much more liquid and much more easily tradable parts of the gold market. That's for GLD, which is why people have been taking advantage of it for its safe haven properties.
All right, now let's talk about use cases and actual allocation. You work with a lot of advisors. Tell us about some of the use cases, some of the strategic allocations that they're using with GLD.
Yeah, I think that you know, anywhere from 2 to 10% is what the conventional wisdom says any portfolio could use as a strategic allocation. I think that I'm meeting more and more advisors these days who are already at 5 and contemplating going to 10, or some people who are even already at 10 because of the increase in the gold price that has increased the percentage share of gold in the portfolio. So that they're now contemplating going to 15. And I think that is a very, very smart move to make when we've seen equities come down quite dramatically with coronavirus after 10 years of gains. We've seen fixed income has not really performed the way that people wanted it to. And of course, everywhere you look, you see negative yields. So the outlook for the two mainstream core pieces of a portfolio is really pretty cloudy right now. I think that this has definitely come to gold's benefit. GLD has benefited from that. We've seen $3.5 billion worth of inflows into GLD this year alone, taking it to well above $50 billion, which is really quite creditable. And then GLDM, the mini product, the lower priced product, is now about $1.25 billion. It's only been around for 1.75 years. It's now about $1.25 billion. It's gone up $250 million again year to date. I think those are fantastic performances. It's gold ETFs doing what they're designed to do.
All right, George, great to catch up with you as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.